have the guest joining us on the show. Abhay Agarwal, founder and fund manager at Piper Serica, joins us to talk to us about just that. Abhay, hi. Good to have you on the show. Let's begin by just discussing that. Last week, when we were seeing last month rather, when we were seeing a slide in the markets, everybody was like, mid caps and small caps are very punchy, but now they're sitting at record high levels, and large caps continue to underperform. Is it a time to perhaps, kind of change your allocation towards large caps because they've underperformed, or stay with the momentum because mid cap and small cap are in a different, league of their own?
Yeah, good afternoon, Anisha. I think the rally in the mid and small caps since April has been very sharp, and pretty much all of us have benefited from that. So what we have been doing is to book profits in the in the small caps and mid caps, and slowly rotate into some large cap names that haven't participated and are looking very attractive on a historical valuation basis. So I would say that, look, it's as the mid and small cap indices continue to go up, make new highs, the stocks continue to do well. Very news driven activity there we are seeing. I think it is a good idea for investors to not get carried away. If you have made good money in small and mid caps, maybe book part of that profit, get partly in cash, and partly increase allocation to large caps. Because what I think is that at some point of time, the mid and small cap rally will tire out solely because of expensive valuations. And that is when we will see the large caps pick up. So I think the investor should be ready for that and not be too late in that trade. And that is exactly what we are doing with our PMS and the fund.
Yeah, I do see that you've increased your cash allocation. You've reduced the mid cap, small cap allocation quite meaningfully from 75% to 45%, and that does back the view that you have. But I was just going through your recent, exits as well. It seems like you're moving away from textile exporters. At the time when everybody's talking about FTA, etc., what makes you a bit cautious on textile exports, specifically?
Yeah, Anisha. So, we actually added some textile export names purely on valuation basis, and we saw them trade at bottom of cycle valuations earlier this year. Gokaldas, SP Apparel, Himmat Singh ka Side A. And these stocks since then have done very well for us. I mean, Gokaldas is almost 3x of what we were, or what it was when we started buying it. And the other stocks have also, SP Apparel is a multi-bagger already. So what we decided to do was to take some money off the table, because as a fund manager, I think it's prudent, and again, coming from my 30 years of investing experience, that when you see such sharp returns, it's not a bad idea to book those profits and redeploy in other interesting opportunities. And we are finding those interesting opportunities in a market which can arguably be called expensive, but there are always sectors that, as in long-term investors, one finds interesting. So what we have done there is, Anisha, book profits, and I have nothing against the textile apparel export story. I think it's a long-term trend, but I think the stocks have run up too fast, too quickly. So it was just a tactical call. We still have them on our radar, and if the valuations come down or some such event happens, we may look to add them back to the portfolio.
Sure, so it's a good tactical call right now given the valuations have become punchy. But then what are you adding at all within large caps as well? Which are the latest addition? If you can name some of the stocks, that will be helpful.
Yeah, sure. Happy to name, with a disclaimer that these are not buy recommendations and we have them in our portfolio. So we have added, Reliance, we have added Kotak Bank, we have added Dr. Reddy's and Divis. I mean, we are actually turning quite positive on large cap pharma segment, because I think after years of struggle with pricing and volumes in the US markets and the struggles with US FDA, I think this is a sector which is now seeing good traction and is very competitive right now. They have adopted good manufacturing practices. They are far better FDA compliant, if I can say that, compared to a few years ago. So I think I really think that some of the Indian large cap pharma companies, especially Dr. Reddy's and Divis, from the basis of the recent work that they have done, is quite remarkable, and I think the market will reward them once the performance kicks in. So pharma large cap is one interesting space. We have also been adding Jio Finance. I think it's a long-term, very structurally positive story. And in agro-chem, we have also added, we are also positive on the whole agro-chem space. I think that's a space that is ripe for re-rating sooner than later. So UPL has been our addition. But there we are ready to be patient because these are bottom of the cycle purchases and they don't suddenly start outperforming. So we know that we will need to be patient and we are happy to be patient.
Being patient is one of the virtues that market does teach you over time. Jio Financial Services, Reliance, Kotak, these are some of the latest additions, and apart from the pharma names that you talked about. But one theme that seems to be working well for you is the entire financialization of savings and the equity market plays that you have. I see CDSL, CMS, CAMS and Angel One, to be honest, in your portfolio. I want to get your view on NSDL as well as BSC, NSC. So apart from these names, would you also look at, let's say, an NSDL post its listing, BSC, NSC as well?
Yeah, that's a good question, Anisha. So let me answer the first part. I think many years ago when CDSL listed and after that CAMS listed more recently and then Angel One listed, our view has been that, look, with the growth of capital markets, as India's GDP grows, becomes from 3 to 6, 6 to 9 trillion dollars, the capital markets will also grow. And what that means is that the companies that provide infrastructure support to capital markets will benefit in a very large way. And these companies are highly technology oriented. And that's the reason we had added CDSL many years ago when it had listed at a price of about 200 rupees, and it's been a multi-bagger for us. CAMS similarly post IPO. Angel has been a great multi-bagger for us, and we continue to hold them. And they have come up in the top 5 holdings purely because of the recent run up in the price. But we are not trimming our position. If the markets may correct, they may correct. But we see them as a decadal long-term story. So I think any company that provides infrastructure support to capital markets is bound to do well. And the business models are such that growth doesn't require capital infusion because they are very technology-oriented companies. And they continue to give cash back to the investors, to the shareholders, which is a great place to be. I think the current valuations are not stretched at all. On the second part of your questions, yeah, absolutely, BSC listed company. We have looked at it, but never added. Maybe we should have, looking at the price performance. NSDL, once it lists, we'll definitely look at it, though we do not like to have competing companies in the portfolio. We like to make one bet, and we already have CDSL. But I think every opportunity that comes up, we look at it with a lot of interest. And if the valuation is right and it's a good long-term story, we would definitely like to add them.
Take there, but Abhay, since you're talking about the IPO additions, etc., are you looking at Tata Tech, even Honasa, Flair Pens, Fed Bank? A lot of IPOs are actually coming in. Anything in the recent times that interested you?
No, I think some of the IPO quality, and I'm very happy with the kind of names we are seeing list. I think for investors like us who are constantly looking to deploy capital and larger capital, I think some of the new listings have been very good, and the pipeline also is excellent. And I think this is what will provide more support and widen and deepen the Indian capital markets, give more opportunities to newer investors who are coming in to participate and reduce our dependence on FPI flows. So having said that, we are quite interested in looking at Tata Technologies. I think it's a company that is again a great long-term play. We have had Dixon in our portfolio for, I think again, since the time it listed. So some of these old IPO plays have turned out well for us. Dixon has also been a multi-bagger. And I think there is place for many more Dixons in the country. I think the whole EMS play, the whole auto design and manufacturing play on an outsourced basis. I think these are remarkable plays. These companies will continue to grow, and with Tata patronage, I think the market will be even bigger for them. So we want to look beyond the current market cap and the valuation, which may look expensive in the short term. But I think once you build in the long-term story, I think a stock like Tata Technologies should continue to do well.
Positive on Tata Technologies, looking at it positively, the entire EMS and the marrying of EMS with technology and software is something which is working well. Thanks so much, Abhay, for making time and speaking with ET. Now, appreciate you being with us on the show today.